For the longest time, crypto has felt like the Wild West, right? A total frontier. Unregulated, packed with opportunity, but man, was it risky. Well, that whole era, it's coming to an end. A massive shift is happening right now, and we're going to break down what it all means for you. Because believe me, the days of the Wild West are done. So, what kicked all this off? Well, it all came crashing down with a series of just catastrophic collapses. We're talking billions of dollars that just vanished. And this quote, it really nails it. The pain was so real and so widespread, all fueled by this crazy influencer hype that, left a lot of regular investors completely wrecked. And let's be clear, this was the moment that truly broke everything. I mean, when FTX, one of the absolute titans of the industry, went down, this wasn't just another bad day for the market. No, this was a full-blown crisis of faith. It pulled back the curtain and showed this deep rot at the core of the unregulated space. It proved that your money wasn't safe, not even on the biggest, most trusted platforms. All of that chaos, well, it was the final wake-up call for regulators. They just couldn't ignore it anymore. So that old world, that whole move fast and break things mantra, it's being replaced by a new one built on actual rules and oversight. So the big question for you is, are you ready for what's coming? Because it is coming, and it's coming fast. Okay, so before we can even get into the new rules, we've got to rewind a bit and look at what broke so badly in the first place. The failures here were systemic. They were deep, so deep that regulators really had no choice but to step in. This wasn't about killing innovation, not at all. This was about stopping another absolute meltdown from happening again. So let's get into the specifics. Let's call them the sins of the era. You had FTX with an $8 billion shortfall because they were mixing customer money with their own hedge fund. Then you've got Binance, the biggest exchange in the world, just kind of living in this regulatory gray area, setting up shop before getting the green light. The common thread here? A total, shocking lack of the most basic financial safeguards that you would just assume are there. So what's the verdict from the regulators? Well, this right here sums it up perfectly. The message could not be clearer. The party is over. The Wild West days of just ignoring the rules, that is no longer a business model. It's done. Enforcement is here. Okay, so we keep talking about this regulatory hammer. What does it actually look like when it comes down? Well, it's not just one single rule. Think of it more like a whole new set of rule books, all designed to bring some sanity to the chaos. Let's dig into the big ones. All right, here are the two heavy hitters you need to know about. First up, on the left, you've got the Genius Act. This is all about making stablecoins, well, stable. It forces them to be backed one-to-one with actual high-quality liquid assets. No more funny business. Then, on the right, we have the Clarity Act. This one tackles a massive headache. Who is actually in charge here? It tries to finally settle the turf war between the SEC and the CFTC by creating clear definitions for what these digital assets even are. And that brings us to this really critical new term, digital commodity. So what is that? Think Bitcoin, think Ethereum, assets that are seen as sufficiently decentralized. The Clarity Act would put these under the watch of the CFTC. Now, why is that a big deal? Because the CFTC is the agency that regulates things like gold and oil, not stocks. So by making this distinction, the law is basically saying, hey, these aren't securities. And for a huge part of the crypto world, that is a massive, massive win. And really, that's the whole point of all this. The goal here isn't to destroy crypto. It's more like domestication. It's about building a safe, sturdy bridge from the chaotic island of digital assets to the mainland of the traditional financial system. It's about finally putting up some guardrails and creating clear rules of the road for everybody. Now, it shouldn't be a surprise that with all these new rules comes a whole new reality for your wallet. For a long, long time, a lot of people treated crypto gains as, let's say, off-the-books income. Well, those days are over. The tax man is catching up, and he's bringing some new tech with him. So yeah, how exactly is the IRS getting so good at this all of a sudden? This is a question every single person in crypto should be asking themselves. Because the answer is not, oh, they're just trying a little harder. No, they have a whole new arsenal of high-tech tools. Just look at this. The IRS is now using artificial intelligence to sift through mountains of data, matching up with the exchange's report with what you put on your tax return. They're using advanced blockchain analysis tools to trace transactions. I mean, it's like something out of a spy movie. They can literally follow the money. And the biggest piece of all, mandatory reporting from brokers. This means There's nowhere left to hide. And here's the form that makes it all happen, the 1099-DA. Now, if you've ever sold stocks, you know about the 1099-B that your brokerage sends to you and the IRS, right? Well, this is the exact same thing, but for crypto. Your exchange, by law, now has to report your sales directly to the tax authorities. So let me just say it one more time so it sinks in. The IRS will know. Okay, all this talk about exchanges and reporting brings us to maybe the single most misunderstood and honestly the most dangerous part of crypto. Who actually owns your coins? You might log into your account and see a balance and think, hey, that's mine. But the reality, oh, it's so much more complicated and way, way riskier than you think. See, in the regular stock market, there's this incredible safety net. It's called SIPC. Think of it as insurance for your investments. If your brokerage firm just goes belly up one day, SIPC steps in and protects you for up to $500,000 in stocks and cash. It's what lets people sleep at night. Okay, now I want you to read this next quote very, very carefully. This isn't some analyst's opinion. This is from the fine print of a huge mainstream platform. They are telling you, right to your face in plain English, that safety net we just talked about, it does not exist for your crypto. Let me repeat that. There is no SIPC protection. And this is the brutal, painful lesson that the FTX collapse taught the entire world. When you leave your crypto on an exchange, it's not sitting in a little box with your name on it. It's all thrown into one big pile with everyone else's. And if that exchange goes bankrupt, you're not a customer getting your money back. You become what's called an unsecured creditor. That's a fancy term for being at the absolute back of the line, fighting for scraps. You'll be lucky to see pennies on the dollar. So if leaving your money on an exchange is basically a huge gamble, what's the alternative? How do you protect yourself? Well, it all boils down to one simple, powerful idea: taking back control. This is where you hear that classic crypto saying, not your keys, not your coins. We're going to dive into what that really means and even see how it connects to age-old ideas of protecting wealth, like holding physical gold. When it comes to taking control, you've basically got two options. On one side, you have a hot wallet. This is an app on your phone or your computer. It's super convenient for making transactions, but, and this is a big but, it's always connected to the internet, which makes it more vulnerable. On the other side, you have the cold wallet. This is the Fort Knox of crypto. It's a physical device, like a little USB drive, that stays completely offline. It offers the absolute highest level of security because your private keys never ever touch the internet. And you know, this whole idea of direct ownership, it's not some new, radical crypto concept. It's ancient. This quote here really gets to the heart of a much older philosophy of wealth. It's the belief that real, lasting security comes from holding something tangible, something physical that you can actually touch, something that exists completely outside the banking system, outside the digital world. It's not about trying to get rich quick. It's about having an asset you can literally hold in your hand and give to your kids one day. And really, that's what this all boils down to. The big lesson from every exchange collapse, from all these new regulations, is this: if you don't personally control your assets, you don't really own them. True control, true ownership, means one of two things. Either you hold your own private keys in a wallet you control, or you hold a real, physical asset in your hand. Everything else, it's just an IOU. It's a promise from someone else that could be broken. Which leaves us with one final, kind of uncomfortable question. As crypto gets all these rules, as it gets taxed, as it gets plugged into the mainstream, is it losing its soul? Is it losing that rebellious spark that made it so revolutionary in the first place? Is the end game here for this incredible technology, which was born to be an alternative, to just become another cog in the very same financial machine it was designed to replace? I don't know the answer, but that is the multi-trillion-dollar question we're all about to watch get answered.